Welcome to the last market update of 2024, brought to you by the Reby Homes team. We all know that there are several factors that drive the housing market. However, one of the largest factors is mortgage rates. 2023 had record low sales volume, and that trickled into 2024 as mortgage rates remained less than favorable for both home buyers and sellers. Buyers paused their home search, and sellers held back on moving in hopes rates would ease and make their purchase or transition softer. Unfortunately for most, that did not happen. So the pent-up demand still exists and inventory is still lacking, keeping the market stable but uneventful. So let's take a look at 2025 projections. Will more homes sell in 2025? Well, Redfin thinks so. Here's what they had to say. We expect existing home sales to tick up next year, ending 2025 at an annualized rate between 4.1 million and 4.4 million. That represents a year-over-year increase between 2 and 9%. We're presenting an unusually wide sales range this year because while high housing costs may price out some would-be buyers, there's also a fair amount of pent-up demand in the market. But don't just take Redfin's word for it. NAR, MBA, and Fannie Mae also expect there to be an average of 5.1 million home sales over the course of 2025. As for home price appreciation, these are the predictions from 15 different entities, all of which are projecting an average appreciation rate of 3% over the course of 2025. Of course, this is national, so there will be markets that may see a plateau or even a decline, and there will likely be hotter markets that surpass that 3%. Chief economist of NAR says this: maybe the worst has come to an end. Directionally, I think there's going to be roughly a 10% boost of existing home sales in 2025 and 2026. As for mortgage rate projections, these have changed quite a bit, but Fannie Mae, MBA, and Wells Fargo all tend to agree that rates will remain between 6.25% and 6.5% through 2025. They believe that this will become the new norm for interest rates going forward. Here's a look at the breakdown that they're predicting each quarter, with all three agreeing that will be below 6.5% by Q4 of 2025. So we expect to see inventory and sales volume climb, interest rates to remain above 6%, demand to pick up a bit with each minor rate decline, and home prices to tick up by roughly 3%. So what about foreclosures? Well, let's take a look. Serious mortgage delinquency rates remain low, and there's no expectation or any indicators that that's going to change anytime soon. Here's a look at delinquency rates dating all the way back to 2003. There's an obvious peak during the 2008 housing crash, and here's where we are today, under 1% and expected to stay there. But how about consumer debt? That's certainly increased over the last 4 years, so let's take a closer look. The orange bars represent student loan debt, the blue bars are credit card debt, the green is car loans, and yellow is mortgage debt, which I agree looks scary. There's nearly $13 trillion in mortgage debt nationwide, and I get it, that's a significant number. However, let's compare it to equity. Home equity far outpaces mortgage debt by roughly $22 trillion, meaning although there is an increasingly large amount of mortgage debt, there's roughly 3 times the amount of equity. So many homeowners who fall behind on payments have the option to pull from that equity and get themselves out of trouble, keeping delinquency rates at an all-time low. And that'll wrap up our national update. Now let's take a look at what's happening in our local market here in the Phoenix metro area. Starting with inventory. Available inventory is up roughly 30% year over year, with just over 19,000 active listings. Historically speaking, that's still considered low inventory. However, the increase is still good news for buyers. If we take a look at just single-family homes, that number drops to just over 14,000. Condos make up 3,100 available units, or 16% of all active listings. That's a huge jump in condo sales from previous years. This graph shows condo listings from 2020 to today, and we can see a 61% increase just in the last 12 months. So why is that? Well, we have some theories. One being significant insurance increases on condos, which can also lead to HOA dues increasing. And that leads to an exponential spike in monthly payments, likely causing a lot of owners or investors to dump them and opt for something else. So yes, there is a rise in inventory, but if we take into account condos and historical averages, we're still coming up short against our demand. The result? A continuous balanced market with some areas seeing baby buyers markets. Average price per square foot for homes under 2,500 square feet and under 800,000 have remained fairly flat with a slight upward trend. November finished at $255 a square foot, which puts us right in line with September of 2022. The luxury market isn't affected by interest rates as much, so their appreciation trends remain volatile, with seasonal fluctuations going back to 2022. November finished with $436 a square foot, and we just had a $14 million sale, so the December price per square foot is going to be slightly skewed. Median sales price for homes under 2,500 square feet also remains flat, with minor fluctuations, and that's no surprise considering rates haven't moved much, leaving both buyers and sellers unmotivated. The median sales price in November was $410,000, and although we still have some closings to factor in for December, it's looking like we're going to remain in that area. Seller paid closing costs remain at an all-time high. 53% of closings under $800,000 have seller paid closing costs, with the average amount being $10,000. This map highlights which areas across the valley see the most in seller paid closing costs. The darker blue highlight areas that have more concessions, while the darker green shows areas with less concessions. So we can see the outskirts are receiving more help from sellers, while areas like Chandler, Gilbert, Scottsdale, Paradise Valley, and parts of Tempe are not seeing as much help. So if you're looking for a really great deal, try looking at homes in the blue areas. Now let's take a look at foreclosures. Foreclosures are measured by tracking notice of trustee sales. Notices are indicators that a home is approaching foreclosure, but it doesn't mean that a property is already in foreclosure. Many homes have enough equity to avoid it altogether, but the notice will still be recorded. So here's a great look at where we are in terms of foreclosures. This is such a great graph because it shows just how drastic the difference is between 2008 and today. So just by looking at this, it's safe to say that homeowners are in a very strong borrowing position. And finally, let's talk about rentals. This graph has not changed much since about 2021. Rent prices fluctuate seasonally between $2,095 a month and $2,200 a month. This map shows areas where rent prices per square foot tend to be higher and lower. The darker blue are the highest areas, so if you're looking for the most affordable place to rent, take a look at the darker green areas. And that'll wrap up our last market update of 2024. We just want to express our sincere gratitude for all of you who tune into these each month and are a part of our real estate family. We wouldn't be here without you, and sincerely thank you for trusting our team to bring you all of your real estate news. We're looking forward to an amazing 2025. As always, if you have any questions or specific data that you'd like to see, please don't hesitate to reach out. We're here to help. Happy holidays, and we'll see you in the new year.